Imagine yourself as a seasoned businessman steering your empire through the turbulent seas of the stock market, where every decision isn't just about numbers on a screen, but a psychological battleground that can build or shatter fortunes. Welcome to the realm of strategic wealth and capital psychology, tailored for ambitious American entrepreneurs like you who juggle boardroom negotiations by day and portfolio tweaks by night, seeking not just profits, but a mindset fortress against market mayhem. Let's dive deep into this, starting with the core truth that wealth isn't amassed through blind luck or hot tips from Wall Street whispers, but through a disciplined psychology that treats capital as your most loyal soldier, deploying it strategically amid economic shifts like the Federal Reserve's interest rate dances or inflation's sneaky creeps that hit USA businesses hardest in sectors from tech to manufacturing. Picture this fresh analogy. Your investment portfolio is like a high-stakes poker game in a Las Vegas casino, where the house edge represents market volatility and your edge comes from mastering emotional intelligence, avoiding the tilt of panic selling during a dip like the 2022 bear market triggered by supply chain woes, instead holding firm with a calculated bluff based on fundamental analysis, scrutinizing earnings reports, PE ratios, and cash flow statements as if auditing your own company's books. For businessmen, this translates to viewing stocks not as gambles, but as extensions of your enterprise, where diversifying across blue-chip giants like Apple or emerging disruptors in renewable energy mirrors hedging your business risks, perhaps allocating 40% to growth stocks for aggressive expansion, akin to launching a new product line, 30% to value plays for steady cash cows like your core operations, and 20% to bonds or ETFs as a safety net against recessions that could squeeze your revenue streams. But here's the psychological twist often overlooked. Capital psychology demands confronting your inner biases, like the confirmation trap, where you cherry-pick news from CNBC or Bloomberg that aligns with your bullish stance on AI stocks, ignoring red flags such as overvaluation bubbles reminiscent of the dot-com era. So train yourself with daily rituals like journaling trades to dissect wins and losses, revealing patterns like overconfidence after a quick 20% gain on Tesla shares, which might lead to reckless bets. Strategically, arm yourself with tools honed for USA markets, such as technical analysis via moving averages to spot trends, say a golden cross signaling buy opportunities in S&P 500 components, or macroeconomic lenses like monitoring unemployment data from the Bureau of Labor Statistics, which foreshadow consumer spending shifts impacting your business's bottom line. Envision building wealth as constructing a skyscraper in Manhattan, where the foundation is your risk tolerance assessed through stress tests, like simulating a 2008-style crash, ensuring you don't over-leverage with margin accounts that could bankrupt your personal finances, just as debt can sink a startup. For the businessman in you, integrate capital psychology by aligning investments with your professional goals, perhaps funneling dividends from dividend aristocrats like Procter & Gamble into R&D for your firm, creating a virtuous cycle of compounding that Einstein called the eighth wonder, where reinvesting at 7% annually doubles your wealth every decade, far outpacing inflation's erode. Avoid the herd mentality that stampedes into meme stocks fueled by Reddit frenzies, instead cultivating patience like Warren Buffett's value investing ethos, buying undervalued assets during fear-driven sell-offs, as seen in the post-pandemic recovery, where savvy investors scooped up airline stocks at bargain basement prices. Practically, implement a weekly review system using apps like Yahoo Finance or TradingView to track key indicators such as the VIX fear gauge, which spikes during uncertainties like election years, allowing you to pivot capital from volatile equities to stable treasuries. Delve into behavioral finance nuances, recognizing how loss aversion, fearing losses twice as much as savoring gains, can paralyze you from cutting losers early. So adopt rules like stop-loss orders at 10% below entry to enforce discipline, much like setting KPIs in your business to prune underperforming divisions. For long-term strategic wealth, embrace tax-optimized strategies under USA laws, such as maxing Roth IRAs for tax-free growth or harvesting losses to offset gains, turning market downturns into fiscal advantages that bolster your net worth. And remember, the ultimate psychology hack is viewing failures as tuition. Analyze that botched trade on Nvidia amid chip shortages not as a defeat, but a lesson in supply chain vulnerabilities, refining your acumen for future conquests. As we wrap this journey, commit to evolving your capital psychology from reactive to proactive, transforming your stock market forays into a symphony of strategic mastery that not only swells your wealth, but fortifies your business acumen, ensuring you thrive in America's capitalist arena, where the bold, the psychologically resilient claim the throne. Now, go forth, apply these insights, and watch your empire ascend.